And welcome. It's episode 25 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, BTR. Thank you for tuning in and for watching. We are at the quarter century mark on episodes 25. And I'm more fired up for them now than I was even back in episode 1 when we were just getting started. So thank you for listening. Thank you for all the 5-star ratings on Apple, Spotify, and YouTube. And if you feel so inclined, please keep them coming, as it helps with the algorithms and getting the word out and whatnot. So sorry to grovel there a little bit, but do appreciate it. All right, so let's get into it. Episode 25 is going to be about the institutional buy box for today's institutional investors. What are institutions looking for, and what have they been doing in this entire cycle? And of course, every investment group has their own buy box. It's going to vary based on who you ask. But I got with me today Michael Van Der Poel, a founding partner in Acre, which is a large real estate fund manager pursuing equity and debt strategies across the country and even abroad in new development, value add, multifamily, and BTR. And so we'll be talking a little about that, both equity and debt. And before we do, I'll be sharing some data as well, just tracking not just institutions, but where are investors going, where are they spending more of their time and their money, and where are they going less? Where are we seeing less capital deployed than we saw in previous cycles? So that'll be hopefully of value. Before we jump in, I want to, as always, give a big thanks to our sponsors. We're not able to do this without these partners. First and foremost, big thank you to JPI, one of the nation's leading apartment developers and doing market rate and workforce, and Madera Residential, one of the leading operators in Texas, especially DFW and Houston. All right, so as always, we kick it off with, here's a chart. Got a few charts today, and I know many of you aren't seeing these on screen. That's okay. I'll still talk you through them. First one, we just got February apartment data. So let me give you some quick highlights here. The apartment rent growth came in at 0.8% year over year. And I posted this earlier, but there's two ways to spin this. Number one, you can say, hey, it's flattish again, where it's been for nearly 2 years. Or you can say the rent growth's up to a 20-month high, with at least in terms of same-store rents for new leases. And both things are true. Either way, momentum is clearly shifting, even if very slowly. It's been trending incrementally upward in each of the last 5 months, and that's aligning with, of course, the peak in supply, that 50-year peak. And now we're starting to work our way back down the mountain a little bit, and you see rent growth just ever so slightly moving back upward. So I've talked about this a lot now. It's the biggest theme in multifamily. If demand remains strong, that should allow for concession burn off in the spring and the summer, and that alone could lead to larger effective rent growth. Now, of course, though, many operators are going to be cautious given everything we just went through. I don't think we're going to see a lot of aggressive rent movement yet, particularly with hundreds of thousands of units still in active lease up, a lot of competition for leases. And the priority, I think, is going to remain, high stabilized occupancy first and foremost, plus continued strong retention. And obviously, as well, the pace of recovery is going to vary by market and submarket, and that's stating the obvious. And on that point, there's still a lot of markets with negative rent growth. Austin's down 7.2% year over year, so it's roughly where it was. It's gotten incrementally better. Denver is now home to the nation's second largest rent cut at 4.5% year over year. There's a ton of supply hitting there these last 6 months, and a little bit of a unique story because I wrote about this recently, but Denver's a market where a disproportionate volume of the supply in this cycle is really concentrated in a relatively tight delivery window. And so I think it's really about supply across the Denver metro area first and foremost, but not much is delivering after that. And so if it really is about supply, you'd think this one should work its way out of the gutter in terms of the rent cut leaderboard. So bottom line, we're obviously far from a back to normal point, but appear to be trending in that direction. All right, so let's move on to another chart. This is a topic that is really central to today's podcast theme about where capital is going and not going. And so I got a chart showing apartment capital shifting away from Northeast and West Coast. It's the chart is showing each region's share of U.S. apartment sales in terms of dollars in the 2020s decade so far. But now that we're halfway in, believe it or not, 2020 to 2024, and then we compare that to market share or the share of dollars in the 2010s decade. And what it shows is that capital has been shifting away from the Northeast. Market share in terms of all apartment sales is down 7.3 percentage points from what it was. So it went from about 24% of all apartment sales to now just over 15% of all, 16%, something like that, of apartment sales. And that's almost entirely driven by New York, by the way. And then the West Coast, we're down 5.2 percentage points in market share, down to about 15% of all apartment sales, was north of 20% in the 2010s decade. And then it's more heavily concentrated. That money is now being moved in. Again, this is allocation, so it's cycle agnostic. It's not depending on how much dollars, really just the share, and that share is moving disproportionately into the Southeast and Texas, especially up 8 percentage points in the Southeast, up 2.1 percentage points in Texas, also up 0.9 percentage points in the Midwest, 1.6 in the desert and mountain region of the country. That Southeast number up 8 percentage points, that's especially eye-opening. Diving in deeper is driven by a few markets here, Miami, Nashville, Charlotte, Atlanta, Orlando. Some of the ones that jump out, but also some relatively big gains in smaller markets like Charleston and Sarasota, especially, and also some other smaller markets like Savannah, Virginia Beach, Huntsville, Knoxville, Fort Myers, Greensboro. So we're seeing increased favoritism across the board there. Let's dive in deeper by metro area across the U.S. And so now we're looking at individual markets across the country, share of apartment dollars in the 2020s, and that's going to be, and we're comparing that to how much it's grown or dropped off since the market share of the 2010s. So when we look at this, we see DFW is the big winner. It leads the nation both in total market share, 7.4% of all apartment sales in the country so far this decade. Also leads the nation for the biggest gain in market share between the 2010s and 2020s, up 130 basis points or 1.3 percentage points. Other big gains of 50 bips plus are in Miami, Atlanta, Charlotte, Nashville, and Orlando. The Midwest, with the exception of Chicago, is seeing an uptick as well. Chicago's down a bit, but Indianapolis and Kansas City are up. And then gateway markets like New York City, Los Angeles, Washington, D.C., Seattle, San Francisco, all attracted a lesser share of apartment investments so far in the 2020s versus the 2010s. You can see New York requires its own scale adjusting, down more than, I'd mentioned this a minute ago, but they're down more than 5 percentage points. Everybody else is less than 2 percentage points decline. Boston's the exception to the gateway rule. It's been steady. Obviously, Boston's been a very trendy, popular market for both demand as well as for capital. Now, when you look at these gateway markets, some of it is going to be COVID driven, of course, given that these markets largely shut down for a year or two during COVID. But, so I did a look at this and even, again, not that 23 and 24 are normal years by any definition themselves, given that there's just less traded in general, I should say. But even as a share of the total, we still saw reduced share of apartment sales going into these gateway regions, again, other than Boston, relative to where they were pre-COVID. So there is definitely a structural shift that has occurred. Some surprise metros losing market share in terms of apartment investment dollars, but to a small degree, down less than 0.5 percentage points, 50 bips. Northern New Jersey, Houston, Denver, Orange County, and Long Island. So Houston and Denver, probably the biggest surprises given their regional peers moved upward. Surprises among markets that gained market share, but not quite as much as you might have thought. Austin was up 30 bips, Raleigh 10 bips, Tampa 20, Salt Lake 20, and San Diego 10. All right. So interesting list to look at. Obviously, just one of many data points. Obviously, a lot of other factors could be influencing these things. But again, just I think an interesting story there. Now, I want to dive into Los Angeles for a moment. It's easy for those of us not in California to pick on California sometimes and just say it's all bad. No one wants to move there. Migration, population, et cetera, affordability. But it can be a more nuanced story. Sometimes we kind of oversimplify a little bit, and it's not all bad, right? And also specifically when we drill into individual markets, we see the story could vary a lot. And that's also true in Southern California. And so I've got a chart here that shows the movement in market share of apartment sales, again, 2010s versus 2020s, in the 4 big SoCal metro areas: LA, Orange County, San Diego, and Riverside. And we can quickly see here that there's not a SoCal issue overall. It's a Los Angeles issue. Orange County and San Diego have both maintained their market share, 1% or so in Orange County of all apartment sales nationally go to Orange County. That's been true in the 2010s decade. Now it's true in the 2020s decade. San Diego's close to 2%, a little under that. That's been consistent. It's actually up a hair. So then Riverside's down a little bit, but not a bunch. And it really leads to a focus on Los Angeles. LA County. It's dropped from 5.4% of all U.S. apartment sales in the 2010s to just 3.7% of apartment sales in the 2020s. And this is the largest county in the nation in terms of population. So clearly something bigger is going on in LA County, specifically different from the rest of Southern California. And by the way, it's the same trend on the development side. LA is obviously structurally undersupplied. It's trying to do some things, and the state's trying to force some things in terms of stimulating more supply, and yet its share of apartment starts nationally is at the lowest levels in 25 plus years. Just 1.5% of U.S. apartment starts occur in the Los Angeles Metro Division, which is LA County. By comparison, it hovered around 3% for much of the 2010s decade. So its share has been cut in half. And not because of supply-demand fundamentals necessarily, but because of the regulatory climate. The data suggests it's, in my view, I think it's just increasingly difficult to classify LA as a core, meaning like definitionally, academically, a core means stable, liquid market for apartment investments. And, that was an really an unthinkable scenario 5+ years ago. But you look at where we are today, investors and developers are frustrated by what's a hostile and unpredictable regulatory environment across the city and the county. The lengthy eviction moratoria, the transfer taxes, the hostile treatment of housing providers, as they're kind of painted as the bad guys. And now LA County's passed another eviction moratoria last week, and it appears that, from my reading of it, applies even to the city of LA. And this one specifically targets renters impacted by wildfires, but it allows renters to self-certify financial hardship and puts the burden on housing providers to absorb the costs and combat fraud. Somebody read some quotes here. I posted this recently as well. Mark Perrell, the CEO of Equity Residential, he said that LA's recent actions, quote, further reputation LA has of being anti-business, anti-housing. It's pushing capital away. One of the big local players, Moses Kagan, he's one I would say is not one typically prone to hyperbole. There's a video of him on social media speaking at a local conference. He said capital providers are looking at LA and saying, why the bleep would we invest there? I've shared this previously, but at NMHC in January, one institutional investor I was on a panel on, he quipped that, LA would be an institutional market only until, quote, I sell everything we have there, and then it's not. And then also, some of you remember I had Camden CEO Rick Campo on the podcast recently, and he shared that only 10% of Camden's portfolio in terms of revenue is in Southern California, but it was 50% of their bad debt during COVID. So, it's really a shame, obviously, because, the citizens of LA City and the LA County deserve better than this. We need more supply. And also, there's lots of investors, big and small, who want to be part of the solution, but they're just worn out, being demonized and hamstrung by local elected leaders. Now, by the way, when I talk about LA as not being necessarily a core market at this stage, that doesn't mean it's uninvestable. But I think it's more of an opportunistic market for institutional and national investors who are looking for this point. You need to account for that risk. I always tell people supply risk is temporary and predictable. Policy risk is unpredictable and almost always permanent. Now, it's also a different equation for local and regional players. Like if the LA is your home base, that's where you do business, and you've got a longer term view, you've got more flexibility in terms of your capital, you can ride this stuff out. potentially you can do really well there. Maybe you could, even do better because there's lesser competition. But the reputational risk and the policy risk there make it more of a challenging equation for the bigger and national institutional owners. And again, by the way, it's not about supply and demand. This is all about the regulatory environment there. I don't want to come across as being negative on the broader market. You can see across Southern California, it's really, again, this is a LA policy issue they have to wrestle and solve. All right, moving on. Next up, rental housing trivia. All right, today's question is, which market, a metro area, did not rank in the top 50 for total apartment sales by dollars over the last 5 years? Is it A, Birmingham, Alabama, B, Charleston, South Carolina, C, Detroit, Michigan, D, Greenville, South Carolina, or E, Louisville, Kentucky? So give that some thought, and we'll look at the answer in a bit. But next up in the news. All right, we got a few headlines with us today. The first one comes from the Wall Street Journal. Blackstone raises largest commercial property debt fund with $8 billion haul. Fund took 2 years to build and will be active in North America, Europe, and Australia. And Peter Grant broke this story for the Wall Street Journal. So debt remains a big strategy among institutions. Now, Blackstone has what the Wall Street Journal says is an $8 billion debt fund that, quote, is matching the record for this type of investment vehicle and offering another sign of a property market rebound. Some of you may remember I talked to Dan Walsh about this shift into debt in an episode a few weeks back. He's doing this too, albeit on a much smaller scale with his firm CityMark. And I'm going to talk to Michael Van Der Poel today in our interview about debt strategies as well. Next up, it comes from Yield Pro, a trade publication that says MSCI, the MSCI Real Capital Index, a data provider, quote, multifamily property prices show positive trends. So this is data from MSCI. And the article, let me read from this a little bit, it says the latest commercial property price report from MSCI Real Capital Analytics says that multifamily property prices were up 0.7% month over month in January. From the revised level a month before. However, prices were down 1.6% year over year. And then interestingly, 4 days later, the same publication, Yield Pro, they reported CoStar's data, and CoStar said its own apartment index showed property prices down 0.8% month over month and down 0.9% year over year. So a little minor discrepancy between MSCI and CoStar, but the broad trend shows not much movement in pricing either way. Of course, down in Texas, I'm sure every would-be seller is gloating over the high 4% cap rate that Avalon Bay said it paid BSR for 8 properties in suburban Dallas and Austin. And one more headline for us this week comes from Business Wire, so it's a press release. By the way, it's always if you go to Business Wire's website, they say put it right under it, a Berkshire Hathaway company, and that's always interesting to think that Warren Buffett, of all his many businesses, that he has Berkshire Hathaway in the press release publication business as well. So he does very well with these boring businesses, and certainly impressive. So here we go. This is a press release from Redfin. They say that Redfin reports new apartments are filling up at nearly the slowest pace on record, but that may change as builders pull back. It goes on to say that less than half of newly built apartments completed in the third quarter of 2024 were rented within 3 months. This is according to a Redfin analysis of U.S. Census Bureau seasonally adjusted absorption rate data for unfurnished, unsubsidized, privately financed rental apartments in buildings with 5 or more units dating back to 2012. I saw this headline. It's interesting. I don't put too much stock in census data on multifamily absorption. To be honest, I forgot to even track this. It's going to be a far smaller sample size than we get from private sector data providers like CoStar, RealPage, Yardi. Now, of course, lease-up velocity is not brisk anyway in the winter months, and especially when that's at the same time we're having a 50-year high in supply. So obviously, I think there probably is some truth to the headline, but I wouldn't make too much of this, again, given the seasonal aspect of it, as well as the volume of supply. And we're also seeing from the data providers more recently here, and this is 2024 data. Now even though it's making headlines now, but we're seeing good reports from the data providers that occupancy rates are stable and or improving so far in 2025. The REITs said similar things about the year coming off to a good start so far. Obviously, the spring leasing season will tell us a lot more. But overall, I think the demand story is pretty good. All right, let's come back to rental housing trivia. The question for this week was, which market, the metro area, did not rank in the top 50 for total apartment sales by dollars over the last 5 years? Was it Birmingham, Charleston, Detroit, Greenville, or Louisville? And the answer is Birmingham. Birmingham, Alabama, ranked 60th with nearly $2.6 billion in sales so far this decade for apartments. And by the way, Charleston, South Carolina, another fun fact, it ranks 71st by population among CBSAs in the U.S., but ranks 39th in apartment sales. So it's punching way above its weight class. And I've talked about Charleston now a few times, but definitely has become an attractive market for apartment investors, and also I think the core apartment demographic. Beautiful city too. All right, so we're going to talk a lot more about institutional strategies and how that buy box is shifting, and not just buy, but lend to. Talked about earlier what Blackstone's doing, what CityMark's doing with the credit strategies, new construction, BTR, value add, markets, international, domestic, and so to get into that, I'm going to bring in my friend Michael Van Der Poel. He's a founding partner in Acre, which is an institutional real estate fund manager. Acre's vertically integrated owner-operator and lender focused on multifamily and investing across the capital stack on behalf of global institutional investors. Got about $5 billion or so in assets under management and have transacted more than 40,000 units. So let's bring in Michael for today's conversation. All right, now we enter the interview portion of today's podcast, and I am honored to welcome in Michael Van Der Poel, one of the founders of Acre. So, Michael, thank you so much for being here with us today.
Pleasure to be here. Thanks for having me.
All right, so tell us a little about Acre, particularly the origin story. What led you and Les to start the company back in 2011, I believe?
Yep. At 2011, spot on. Yeah, we're a private equity real estate fund manager focused on residential housing strategies with both debt and equity funds that we deploy out across the country and across the world on behalf of institutional investors, traditionally through closed-end funds. So we've built a funds management business. But yeah, we had humble beginnings in Singapore, where we met. Both of us were leaving long careers in the banking, coming out of the banking world, essentially. Les was at Morgan Stanley for 25 years. I was at an Australian investment bank for nearly 12 years before that. The world was obviously a mess after 2011, coming out of the ashes of the global financial crisis. Somehow through just, sourcing deals, I came across multifamily in the US, which was a new asset class to me. I hadn't really I'd done a lot in my career up until that point, but hadn't really invested in multifamily before. Made a couple of trips over the US, got a portfolio under contract. Back then, workforce housing was not an institutional asset class at all.
Right.
And it was trading at 8, 9, 10 cap rates, and some of the price per doors that we were seeing kind of really struck a chord. We were seeing at the low end like $5,000 a door, to kind of $15,000 to $20,000 a door on some of these properties. So that was the penny dropped, and we were like, this just is a fascinating asset class. We started doing and obviously a super interesting entry point. So we started doing more research on multifamily, and we found this big bifurcation between institutional owners and operators and workforce housing. And that, over the course of a year or two of research, led us to write a white paper about workforce housing and how it was kind of misunderstood and uninstitutionally owned and trading much wider than A grade, and it would be a good complement for a whole host of reasons that we put some academic thought behind to invest in. And I basically had that thesis and a portfolio under control, and I went to raise some capital from friends and high net worth individuals, and came across Les, and he was leaving the banking world, and he was looking to come back to America, and we did a couple of diligence trips and struck up a friendship. And it was a fortuitous way to get together, but it was all off the back of that backdrop.
That's amazing. Well, first of all, you timed it really well, obviously, and second of all, I'm sure everybody who's watching is going to be longing for the good old days when you could buy it or $5,000 or $10,000 a door.
I know, it's crazy.
It's wild. Crazy. All right. So at these last, 14, 15 years, you've done a lot of everything in multifamily, value add, distress repositioning, recapitalizing, lending, lease up, ground up development, obviously affordable and workforce housing you mentioned, and obviously a lot of workforce housing. So over that time, what's really emerged as the sweet spot for Acre in terms of strategies and markets where you're finding the most success?
Yeah, I got your question. I was thinking about it. I think the answer on a whole is we actually have, I think, pride ourselves on moving with the market and finding opportunities that cater to the current market landscape rather than just doing something kind of programmatically over and over again, no matter what's happening. We've really been successful in trying our best to time the market and cater towards what's the landscape, what's happening in the macro landscape at that point in time. That's emblematic of the origin story. No one was really doing workforce housing, so we found a gap there. We have since kind of phased that out, and we can talk today about what's going on in the different segments. Workforce is now probably seeing more of the distress that's playing out, and we have some battle scars and history in workforce, but then we saw a gap in acquisition lease up. We saw a gap in development. We still think there's a big runway in BTR. That's somewhere where we spent a lot of time and money. We saw a gap in the lending side of the business, which we've grown into a meaningful vertical within the firm, catering to the debt markets and the private credit cycle. So I think, not evading the question, but we are we like to talk to our investors about us, again, catering towards what's going on in the market at the moment and trying to create strategies and products that suit the time, but still with the multifamily focus as a sector specialist.
No, that makes a lot of sense. And workforce is interesting. It has evolved so much where, the naturally occurring, there's, so many issues now with CapEx and, rent collections issues, regulatory issues. It seems like if you're going to be in that space, it's really more the new construction side of where there might still be opportunities, I would assume.
Yeah, correct. And I think a lot of late entrants into the space at the, peak of the cycle, assets that have older capex and all the issues that you spoke about. I think just another big theme that people are talking about is just the elasticity and ability of people to pay rent at that end of the spectrum. And our in-house view is that, rents are going to continue to rise over the next 3 to 5 years, just for all the things you write about and we'll chat about today, the lack of supply, just structurally lack of supply, the lack of development going on at the moment. So unfortunately, as always, the people that are hit the hardest are at the affordable end of the spectrum, and they've had such a big run up in rents already. I think the P&Ls at workforce housing balance sheets have shrunk and the margins are thinner, and there's just not that much juice left for people to actually squeeze out of the lemon at the workforce AMI end of the spectrum. So we worry about that and think about that a lot.
Yeah, no, that makes a lot of sense. And, obviously, this, but people watching them, something I talk about a lot is, there's this counterintuitively, there's an inverse relationship between rent level and affordability. So people at the lower end of the price point pay a higher percentage of income toward rent just because their income is so much lower. Well, Michael.
That whole adage of 30% being the kind of base case for disposable rent is, I think, probably left the equation a while ago, and it's been approaching 50 in a lot of end of the spectrum that we look at.
Yeah, and the Class C and below type market. So historically, let's shift gears a little bit. You mentioned kind of following the opportunity, right? And historically, one thing we're seeing emerge is that, we've previously, a lot of institutions have avoided the Midwest and the suburban Northeast. We're starting to see that change as investors are seeing the appeal of these as steady eddies. They've outperformed the big coastal cities, which have been volatile. They've been outperformed the Sun Belt, which had its supply issues the last couple of years. So, and I know Acre's now eyeing some of these markets too. So what do you like about those regions, and what in particular markets stand out for Acre?
Yeah, we're definitely trending off the same data and research that you've been putting out. We've probably had in the previous funds 25% of the portfolio in the Midwest. So we've been investing in there in the Midwest for 14 years, but it hasn't been a concentrated market. So we've got to know it and really think that at this point in the cycle, it's a great place to be. All the things you've written about, the lack of oversupply, the strong economies that are kind of understated in a way and just kind of chug along. And now we're seeing that in rent growth that we're all seeing outsized rent growth in the Midwest, which was notorious for low rent growth. So for those reasons, and that it hasn't been inundated with oversupply, are some of the structural elements of why we're hunting in the Midwest. We think there's great buying opportunities. Cap rates have also been more favorable, approaching the 5.5 to 6 end of the spectrum in some of the great cities like Chicago. So we like Chicago. We've always liked Ohio. We're invested in both and in Cleveland. Some of the Rust Belt as well kind of spills into that narrative where we've been investing in both sides of the debt and equity spectrum. I think the newest markets for us, we've always had a New York-based city office. However, we've done very little on the equity side of the business in the Northeast. The Northeast is somewhere where we're actually proactively building pipeline and putting dollars in the ground, and all off again the Bay, the same themes that I just mentioned: barriers to entry, lack of pipeline, complete lack of pipeline in some of these strong markets, but juxtaposed by very strong population and AMI and industry. We're anticipating really great rent growth in these markets. So tough from a permitting perspective to get the right opportunities. But yeah, the New Jerseys, the Long Islands, the Connecticut's, the Bostons of the world is where we've added to our latest fund strategy as a high conviction sector.
Yeah. So what about new development in particular? Obviously, the big drop off in starts, low supply in 26, 27. At this point, everybody knows that's the outlook. So are we at a point where it starts to make sense for institutions to invest in new development again?
Totally. I think we're here right now. I think one of the problems is there's an inundation of developers needing LP checks. LP checks being is probably the toughest part of the capital stack to fill out today. So we are selectively choosing sites to deploy capital into out of our equity fund. We think it's the perfect time, but you can really throw a stick and hit 1,000 people putting their hand up for LP equity these days, and you have to really be selective and choose the right partners. Or we're doing ground development ourselves as a developer too. So definitely are doing that. Definitely believe it's the exact right time now. Counterintuitive trade. LP equity is starting to trickle back in, but it's still very, very slow. So I think it's a great time to get ahead of the next cycle. We're doing the same through our lending business. We're supporting our borrowers and developers on ground up construction finance, where we're offering an alternative to banks, being kind of 60 to 70% loan to cost and having non-recourse. So we're making those bets on both the equity side and the debt side of our business from greenlighting development.
Yeah. You mentioned the debt side of the business several times, so I want to talk about that. I had Dan Walsh from City Mark Capital talking about this recently, shifting from equity to debt, just seeing more opportunities there. You've been doing this for a while. I think you said $2 billion a year in bridge loans, construction loans, preferred equity. So everybody wants to, not everybody. I mean, obviously, a lot of institutions looking at private credit right now. So where are you, as somebody you've been in this for a while, where are you seeing opportunities right now that match opportunities for groups like Acre with needs in the market for those pursuing credit?
Yeah, I think we're probably most active on our first mortgage whole loan bridge program, helping people refinance new development that's coming into lease up and providing a runway to stabilization and hopefully a Fannie or a Freddie sale, a takeout or a sale in a better environment, and or people acquiring new properties that need a little bit of higher leverage or quicker execution than the banks or Fannie and Freddie can offer. So that's our sweet spot right now. We're the bridge market as we speak today is on fire. Spreads are almost at their lowest levels ever in the low 200s for bridge finance. So it's a great time to be a borrower, and we're starting to see that trickle down into acquisition activity because people are taking bets on 5.5 cap deals, and you can almost eke out positive leverage at this point without debt finance.
Wow.
So, yeah, first mortgage.
Almost, you said. Yeah.
Almost, yeah, not there yet. First mortgage bridge loans, construction loans, being creative and providing kind of a seamless execution and quick execution is what we pride ourselves on. We're also doing a lot of preferred equity deals out of the equity side of the business where we're helping people pay down debt, shore up capital stacks, and again, generally buy time to complete business plan executions or get into a better rate environment so that they can live to fight another day. So equally active on the pref equity side of the business, and yeah, lots of touch points between that borrower network.
Yeah, absolutely. Let's talk about another hot topic. That's value add. Obviously, a lot of activity this last cycle. It's much tougher in a high rate, low rent growth environment. You mentioned earlier, talk about workforce, and especially as you get there's a certain profile of value add, the oldest stuff, the more challenged. That's, I'm sure, almost impossible to make work right now. So, what's the profile for value add investments? So what's the buy box that really makes sense right now, if anything, for value add that could actually pencil out?
Yeah, I think for us, we're looking at kind of 2000 plus vintage that really hasn't been touched before. And like you said, a lot of the stock got done in the last cycle, but there definitely still is, opportunity to find properties that have 70+% of the rent roll that have 2000 level finishes and amenity. So I think once it gets a little bit older, and it's definitely market specific and deal specific, you could find some really older assets in fantastic locations that are worth spending the money on. But generally, we're looking at kind of 2000 vintage and 9-foot ceilings as a cutoff to be into the more modern era of the build cycle for us to get excited about value add. And yeah, it's hard to make a pencil. People's value add projects are hard to execute. They take a lot of time and a lot of risk. And I think, the returns still probably today don't reflect the true cost of capital to doing them. For us at 12, 13, 14 IRR is just not good enough for all of that risk. So that it's added complexity in trying to find a deal that works.
Yeah, and I run this by you too. It seems like the value add, increasingly the submarket location matters a lot to me. Like it's like before it was like, hey, we want to be in X market, right? But now like I hear a lot more about, if you're going to do a value add and take on that risk, you really want to be in places where the incomes can support the value added rent levels, and there's maybe you still have a healthy distance in the rent levels at post renovation with the new construction. I mean, it just seems like there's much more, nuance that's important for value add to really work right now. Is that fair?
For sure, yeah. And in addition to schools, continue to play a huge role in just specific borderlines in submarkets, employment basis, traffic patterns. But yeah, definitely, you can't just jack up the rents to be, obviously deal dependent, in line with new comps and expect to get the same rent experience and price. So for sure, a lot of nuanced study to make a deal work.
Yeah, and also, I mean, a lot of the busted value add, especially, I'm here in Texas. I mean, a lot of the stuff around us that didn't work was oftentimes stuff that was value add in the wrong submarkets where there's just not demand at those rent levels. Unfortunately, late cycle type stuff, and that's where I think we're going to see some challenges.
Correct. Yeah, we really haven't seen a lot of distress play out en masse. Everyone kind of expected it with the serious dislocation in interest rate cycle that we've gone through. But I do think the banks and maybe the agencies are sitting on some pools of stuff that they've been kind of maybe waiting to see what happens with the rate environment, and at that time, operationally, things can get pretty tough. These are living, breathing organisms, and if you take your hands off the steering wheel of one of these assets, they can head south pretty quickly. So we're still expecting to see some good buying opportunities out of the last cycle that really haven't come to fruition just yet, and we're poised to hopefully help people out or acquire and fix that.
Yeah, what I'm really curious about is like how much the distress that emerges actually aligns with sort of the institutional buy box, because it seems like there's a disconnect. Of maybe we'll see more that kind of fits that box as time goes on.
Yeah, totally. Like I said, we've got battle scars in workforce, and when we're sitting down with someone and get into the kind of nuts and bolts of what can really go wrong on these workforce deals, it takes you got to have the stomach for it.
Absolutely. All right, let's talk about one of the other kind of new opportunities right now, and that's build to rent, BTR. What opportunities you seen in BTR, whether it's acquisition or development, markets? What are you seeing there?
Yeah, we're seeing executing both. We've got more than a dozen lease ups underway in BTR and various pockets of the country in the Sun Belt and Midwest. For the most part, they have definitely fit the thesis that there is a renter pool that wants a different product. They want to be out of cities. They want space, and they want to have a homeowner experience. They want to rent the homeowner experience. So I think we still feel that, and many of them are on a trajectory to home ownership and just not there yet, or circumstantially don't want to buy a home, particularly with the mortgage rate environment that we're in right now. So I think it's a growing and underserviced pool of renters, and still an emerging, really a sector of multifamily that's in its infancy still. I really think if you project out, it's going to just be another large pool of institutional capital that ultimately owns these for the essentially multifamily assets, but they just are horizontal multifamily. So we're big believers in the structural shift to BTR from a renter perspective. They definitely are commanding a premium in rents and cap rates still, but there's definitely learnings along the way. They take much longer to lease up than we expected. The renters are far more discerning. They want to shop around almost like they are buying a home, and there's not the same renter that sits in an apartment building and signs a lease day one. Which means your lease ups aren't 20 or 30 a month. They're 5 to 7. So that means you might have to have smaller projects. So there's lots of learnings along the way. The maintenance and the gardens and the fences and the garages, all little nuances that need to be embedded into the projects from our perspective to make it comparable to multi and have some of the compete with multi with the rents. Lots of learnings. We love being in master plan communities that already have for sale. Successful for sale phases completed that add to the flavor of someone feeling like they're a homeowner and living amongst homeowners, but adding that clubhouse and amenity and pool so that they still have someone managing the property and answering the maintenance calls and all the benefits of being a renter too. So that's our sweet spot on BTR. We've mainly been investing in the Midwest and Southeast so far in BTR.
Yeah. So let me go back to something you said that I thought was interesting. So you like those mastermind communities. Are you seeing, is there a demographic that maybe wants to be a buyer, maybe wants to build a home in that subdivision, but can't for whatever reason yet? And so they want to, maybe the BTR option nearby allows them to kind of an entry point into that neighborhood. Is that the play?
Totally. It's either a landing pad for them to kind of learn the neighborhood, check out the schools, understand if they really want to make a renter decision and take a year to do that. Maybe lay it on with the mortgage rate environment and a few other things. So on these, normally the BTR as a offering in the broader, larger master plans is only a small percentage of the overall stock. And there's definitely enough transition in those economies to cater to a 200 unit BTR project. So we really like that end of the spectrum. They're also the cradle. What do they call them? The grandfathers and grandmothers that are coming down to live with their grandkids, which is a big part of the demographic that we didn't anticipate would be as strong as it is. Yeah, leaving cities and following grandchildren to be nearby has been a big popped up on the red roll as a big component of our demographic.
Yeah, interesting.
Most of them are lean to be towards more renters by choice, and on a kind of trajectory towards home ownership.
Yeah, makes sense. Let me ask you a question. Just kind of tying this together, because I want to go back to the debt topic for a moment. So we've talked about value add, new construction, markets you like, BTR. When you look at equity versus debt, the assets profile, is it similar, or are you willing to take on a different asset profile for the debt versus equity play?
Pretty similar. I mean, that's when we talk to investors about our differentiation, we really have a lens up and down the capital stack through almost a living perspective now, because we're touching so many different types of multifamily sectors, markets, and strategies. So everything that we're doing on the debt side is really replicated on the equity side too. We're looking at similar underlying collateral and properties.
Yeah. And I'll ask you another question. So you mentioned you and Les met in Singapore, and you're one of the few institutional groups. There's obviously a handful, not very many, that also invest in multifamily internationally, and not just international investment, but actually kind of multifamily. And I believe y'all are in the UK and in Southeast Asia, and American style multifamily is a far less mature asset class in other parts of the world than is in the US. So can you talk at all about the opportunities you're seeing abroad, and whether you think we'll see more American style rental apartments in other parts of the world?
Yeah, I think we definitely will. I think this global drumbeat of unaffordability and home ownership being less attainable is just going to unfortunately drive renting as a necessity. So we've tried to export best practices in other markets where we have relationships and execution capabilities. Singapore, one of the co-founders of the firm, originally Blake Olofsson, stayed in Singapore, and he's executed a fantastic strategy and a branded product that we call Homer in Southeast Asia, where we've got, I think it's close to nearly 2,000 apartments now, in markets like Thailand and Indonesia and Vietnam, where multifamily wasn't really an asset class at all. It was really a shadow market for condo inventory that was rented. So introducing that from a zoning perspective all the way up to property management and to the renter has been a rewarding and exciting experience, and the guys have done a fantastic job. UK, similar story, similar backdrop, much more institutional capital, and I think equally bigger runway for the renter in the long term. So we've had a great experience in both, and now have institutional US grade multifamily assets with all the amenity and leasing office and the like that many offshore properties never saw before, and the renters over there are benefiting from it.
That's great. That's exciting to hear. Well, Michael, I sure appreciate your time today, and thanks for sharing your insights with us.
Pleasure. Thanks for having me on. I'll be back anytime.
And that's a wrap on episode 25 of the podcast. Big thanks again to Michael for joining us. Thank you to JPI and Madeira for your sponsorship. And thank you to all of you for spending part of your day with us. We'll see you next week.